Good afternoon. Thank you for joining us for this webinar, Integrating the Value of Sustainability into Your Small Business Model. I'm your moderator, Renee Goodnow from the New York Small Business Development Center. Joining us to lead things off and to introduce our presenters is PACE SBDC Director, Andrew Flam. Andrew, I'll turn things over to you.
Super. Thanks so much, Renee. Good afternoon, everyone, and thank you so much for joining. As Renee mentioned, my name is Andrew Flam. I'm the Regional Director of the Small Business Development Center here at Pace University. We're based in Lower Manhattan, and welcome you to, I think, what's going to be an exciting session and certainly some very topical information as you build and grow your businesses here in New York State. Wanted to sort of touch briefly on kind of who we are, what we do, and hopefully how we can be of assistance to you in your business. But want to really leave the session and for very, very kind of powerful information from our colleagues today. So as Renee mentioned, our center is part of a network throughout the state offering business advisory services to both existing small businesses as well as aspiring entrepreneurs. And all of our work is offered at no cost to our small business clients. So what I will do after my brief comments, I'll put information in the chat with regard to how you can get in touch with us and how you can request a one-on-one business advisory session. These sessions are oftentimes focused on access to finance, support with your marketing efforts, opportunities with respect to procurement, and other operational challenges you may have. So if any of these strike a chord, certainly reach out, let us know, and we'd be happy to work with you. We also offer, as today is a good example of a wide range of webinars, free training sessions available to small businesses throughout the state, helping them look at more deeply into individual topics of note and how they can kind of help impact their business. So I will also add to the chat a listing of all of upcoming sessions. Feel free to attend one or many as the topics are relevant for your business. Finally, I'll make a quick reference. Our business advisors, these are full-time advisors offering no cost and confidential services. Many of them really have been focused on helping a wide range of businesses with COVID-19 recovery and access to resources that exist. So for those of you that are interested and want to work with an advisor, making sure that you can tap into and access the wide range of public and private sector resources that are out there for you, I will stick a link in the chat about that as well in terms of programs that are available. And as I said, you can connect with an advisor to talk more deeply about them and see which may be a good fit for you. So with that, I am going to scoot out of the way and turn the floor over to my colleague, Steve Mezzio, who's a professor and associate dean here at Pace University, as well as Rick Kravitz, who is from the New York State Society of CPAs. And I think two industry experts on the topic of sustainability, and I'm really looking forward to your comments and Q&A afterwards. So Steve and Rick, table's all yours. Thanks so much.
Thank you. Thank you, Andrew. Thank you, Renee, and thank you to the Small Business Development Center for inviting us to speak on the topic of sustainability. If we can go to the next slide, you can go to the next slide, please. So we're going to really focus our discussion today just on three sort of broad categories, and the first one is just to provide some big picture context to what's happening in sustainability and ESG today, and certainly as it relates to small business. The second point number two is we're going to consider the cost benefits of integrating sustainability and ESG into strategy and business models. And then we'll conclude with some thoughts around how you might get started or how you might begin to implement or integrate ESG into your business models, particularly once again, from a small business perspective. So by way of background, again, my name is Steve Mezzio. I'm an associate dean at Pace University in New York City, and I'm also the executive director of the Center for Sustainable Business at the Business School at Pace University. And we do advisory services to clients and to companies of all sizes. We do learning and development, and we provide training and speak at webinars and as we are today. Rick, I'll turn it over to you for a bio and an introduction.
Sure, I'm Rick Kravitz. Welcome. I'm the editor-in-chief of the CPA Journal, and which is the voice of the profession for the New York State Society of CPAs. Online, it goes to over 200,000 viewers a month, and in print, over 40,000 print subscribers. I'm also the founding director of SILC, which is the Sustainability Investment Leadership Council, in conjunction with the New York Hedge Fund Roundtable. So we've also instituted special issues on sustainability to inform our professional members about this new emerging and fast-paced growth area.
Excellent. Thank you, Rick. And both Rick and I have prior experience in the professional business world, and so we bring that experience in our current interaction over the last 10 years. We've both been involved with sustainability for the last decade, and we have not seen the velocity of change going on around this ESG movement as what's happening today in the current environment. Go to the next slide, please. So we're going to start off, as discussed, with sort of some bigger picture issues, and I'm going to pose a question, Rick, to you. Just as you can see the quote from the consulting firm McKinsey, and the quote is, "Integrating ESG is not an option; it is a mandate." And this is sort of the warning from McKinsey to companies of all sizes. So why is this a mandate, Rick? Why is this happening?
Well, if you turn to the next slide, business leaders maintain that integrating ESG, environmental, social, and governance, into the DNA of our respective businesses is no longer an option. It is the lens through which companies will be evaluated, not only by embracing these principles positively, but by demonstrating their commitment to action. Another way of looking at it is, according to John Bogle, who's the former CEO of the fifth largest mutual fund, Vanguard, who said that the focus is on profits with purpose. Companies with this commitment are the companies that institutional investors are looking to invest in today. And it's also been demonstrated that a more socially responsible business that focuses on stakeholders, that is customers, suppliers, employers, employees, and investors, over the long term will create greater value and greater profits than those enterprises which don't. So we could, I guess, turn to the next slide.
Yeah, no, just conclude on that.
Okay.
Yeah. One of the things that you point out that I think is crucial, and I think it's particularly relevant to smaller businesses, is that increasingly customers, suppliers, the community that businesses operate in are all beginning to look at the performance of companies of all industries, companies of all sizes, startups, small, medium size. They're looking to companies in terms of evaluating their performance, no longer solely on profit as a success measure of a company. They're now expanding the lens, as you rightly pointed out, Rick. They're expanding the lens of performance on how to evaluate company performance by looking at not just profits, but also environmental stewardship and social responsibility. And we're going to talk a little bit more about that in the next question, Rick. And so you're talking about purpose with, and you're talking about a broader sort of mission of companies. But what really has changed in the business ecosystem today compared to previous generations, and do these changes impact smaller businesses?
I'd suggest that there are actually 4 transformational changes during the evolution, and I'll discuss each one separately, but let me just list the 4. First of all, competitive advantage. That is the value of being a purpose-driven firm. And Steve, you talked about it at all sizes of firms. And second, the growth of intangibles, the hidden assets of an enterprise. Third, some of the supply chain issues that we've seen very recently, especially during COVID. And fourth, as you mentioned, Steve, the real evolution from shareholder value to stakeholder value, and what I would say is from financial capitalism to sustainable capitalism to long-term value creation. But let me go through each one of these. If we turn to number 7, slide 7. I'd like to discuss a couple of the competitive advantages of being a purpose-driven firm. Deloitte, one of the largest accounting firms in the world, just completed a special research project, and they concluded that companies that are purpose-driven outperform competitors by over 11%. So not only do you generate more profits, but purpose has another societal benefit as well. And then there's also another competitive advantage. There are organizations like Ethisphere and others that are actually promoting the most ethical companies, and they're rating companies based on their social responsibility and their ESG focus. In fact, it's a competition among the large companies for boasting rights for their customers. And then the other thing we notice that is Gen Z and millennials, especially during COVID, are selecting more sustainable brands and more sustainable companies when they buy products through the mail. Foods, especially, that advertise they are sustainably sourced or sustainably made. And in fact, in the biggest companies, 90% of public companies publish a sustainability report now. And in fact, in the accounting arena, there's even a private regulatory body funded by Michael Bloomberg called the Sustainability Accounting Standards Board. But there's another reason to stay competitive, and that's paying attention to some of the new governance issues. For example, we were just talking about this before we came on. The Department of Labor on Wednesday proposed a rule that permits plan fiduciaries, as pension plan fiduciaries, and most of you have pension plans, to consider climate change and other environmental, social, and governance factors when selecting investments and exercising shareholders' rights. When the SEC actually 2 weeks ago started working on, actually it was two weeks ago, started discussing the new reporting initiatives on ESG. And NASDAQ now, as of 2021, those are the smaller companies, requires all public companies regarding governance to focus on diversity at the boardroom, diversity of thought. And these are all part of our ESG equation.
Yeah, and just to conclude before we go to the next slide on this whole idea of so-called purpose-driven, Rick, the idea is that traditionally a company would create a vision statement and a mission statement. What we're seeing now is this sort of purpose statement, or some organizations call it a promise statement, is back to this idea of having an integrated purpose of what we'll talk about later on in the presentation is social, environmental, and then company success, which could be profits and long-term values. So purpose is a more comprehensive, inclusive mission statement of the past, if you will. Is that a fair way to describe it, Rick? Would you say?
It is, Steve. In fact,
Yeah.
just this week, Walmart mentioned that they were donating, or they're setting up $50 million to develop U.S. manufactured products, because Walmart has been criticized in the past for not paying attention to their local communities.
Excellent. Your next slide, please.
So the growth of intangibles, this is the 2 of the 4. Unlike brick and mortar companies like 100 years ago, like U.S. Steel, today 84% of the value of a company lies hidden in its intangibles. These are the dominant creators of value. Includes reputation of a company in the eyes of the public and the media, brands that make customers feel good about buying, these conceptual assets like intellectual property, patents, trademarks, trade secrets, an intelligent and skilled, stable workforce. And that's all effective for small business as well as large business. Business processes, supply management, chain management, which we'll talk about a little later, and sustainable sourcing. And we're going to talk about that. But if you think of intangible assets, think of Amazon. They really do nothing tangible, but they can deliver a product anywhere in the world faster, more efficient, and cheaper than any of their competitors. But they own nothing effectively. And then think of business disruptor models like Lyft and Uber's, all intangible assets. And regarding intangibles, the fact is that since 1970s, investment in non-financial assets, these hidden assets or intangibles, have outpaced tangible assets by a factor of 3 to 1, and amount every year to about $2 to $3 trillion a year. And think of intangible assets in your small business outside of your accounting firms. For example, if you look at the largest business, Apple, their market cap or their value is 100 times greater than what's on their books. And think about, as a small business, what your intangibles are, what your relationship with their customers are, to your employees, your suppliers, and so forth. Now, if you look at the hidden assets of the top 5 tech companies like Facebook and Google, they're 75 to 100 times greater than anything on their books. And that's, I think, clearly what we mean by intangibles. Then let's go to the next slide, and let's talk a little about supply chain. Now, I teach an advanced course in risk at the graduate level at Texas A&M Law School, and most senior executives, I've been doing this for 4 years, were totally unaware of supply chain risk until COVID hit, or till the Texas ice storm hit, which happened 4 times in the last 15 years. But inattention to supply chain risk and supply chain sourcing is arguably the greatest risk than anything that's physically owned or managed. It can destroy value faster than any other tangible or intangible asset and lead to long-term value destruction. Let me give you an example, pandemic risk. I was talking about rare event or pandemic risk 4 years ago. And it was not a question of if, but a question of when, because we have H1N1, H2N2, SARS, HIV, now COVID, outside of the United States, outbreaks of cholera, smallpox, and West Nile fever. But what is the consequence of that for small business and large business? Box stores like Costco and BJ's, a lack of drivers and closing of the borders up north meant a lack of toilet paper and paper towels for most of us. Paper mills and printers ran out of paper pulp because they could not get their sources. So are some of the other supply chain risks, which we absolutely have to pay attention to, because most businesses today are global, or they source globally. Geopolitical risk of foreign appropriation, military activities impacting sourcing. Now, China, for example, just announced that they're reducing electricity usage in manufacturing. So that affects Tesla, it affects all Apple, it affects all the companies that are actually manufacturing in China. And then in the United States, another supply chain risk because of massive imports and shortages of ship crew, huge bottlenecks in the largest port cities in America. Some goods are just stuck on cargo ships on the East Coast and West Coast. But closer to home, if you source any supplies, over the last 2 years, there was the largest bankruptcy of a trucking company in the United States, where there are 1,000 trucks stuck at truck stands across the nation. They did not deliver their goods. Now, let me give you a quick example. One of my students was a corporate risk manager for REI, which is actually a shareholder company. And after my discussion about intangible risk and rare event risk, she set up shell factories in Mexico and Puerto Rico. And when her manufactured goods stopped being shipped from China, they put 2 factories online. And REI, during this whole COVID, faced absolutely no shortage of winter coats or clothing. And they are considered one of the most admired companies because now they're a shareholder owned by customers. So the management of the supply chain also includes product stewardship, codes of conduct, and a lot of the large companies now have to actually go down their supply chain and make sure that their suppliers are adhering to human capital issues regarding forced labor, conflict minerals issues, and natural capital and environmental dumping. Now, there's also another intangible, and I think, Steve, you talked a little about it before, and that's reputational capital. And it's really the difference between what I call Nestle and Hershey's. Hershey's actually harvest sustainable cocoa plantations, and they actually bring teachers to teach children who have to work in Africa and in South America to become literate, and they actually pay for scholarships for these children to go to higher education. Hershey's is a totally socially responsible a business. Now, let me tell you, it's a funny story, but it's also a tragic story. And why the chickens could not cross the road in the United Kingdom. A couple of years ago, KFC, they had 300 stores and restaurants, decided that they would change delivery, and DHL was the lowest bidder. and DHL was supposed to supply frozen chickens to the 300 stores. But oops, DHL didn't know how to freeze chickens. You know, they're great at sending packages, but they're really terrible about freezing chickens. So 1 million chickens had to be destroyed, and all the KFC stores in the UK, London area literally were out of business for a couple of weeks. And then to top it off, there was a gravy shortage about 2 weeks later. So that's some of my examples, Steve.
Yeah, Rick, I think for smaller businesses, the transport risk is even a risk for smaller businesses. The smaller vendors, smaller suppliers are all face similar issues in terms of transport obstacles. But I think the branding issue that you just discussed is even more relevant for smaller businesses. And no matter what the size of the business, what we're seeing is you really need to have transparency into your direct suppliers, but equally important to who your direct suppliers may be outsourcing further to other vendors that you may not even be aware of are part of your supply chain. And the way the ESG movement is evolving and at frankly a rapid pace is that stakeholders, influential customers, influential community representatives are holding companies responsible for their full source of products and for their full interaction with supply chains. So it's really transparency into your supply chain, regardless of the size of the company, Rick, is crucial, isn't it?
And Steve, when you think of reputation, you think of the millennial generation, Gen Zers, and the people that are really looking to make the world a better place, and they're looking to small business, medium business, and large business to satisfy that need. And that's critical because they will pay on average, and there's been a study done, 20% more for a product if it's sustainably sourced.
Of equal value and equal quality, they will pay more if they believe that that their purchase is helping to make the world a better place. And it's absolutely spot on, Rick.
Right.
Next slide, please. Stakeholders, Rick?
Yeah, so what's changed over the last 50 years that makes this transformation from owner value to stakeholder value so critical? I'll give you a couple of examples. First of all, it's the size of the business. Here's some amazing stats. The 52 largest economies of the world today are not sovereign nations, but multinational corporations. The market cap of Apple is larger than the GDP of all European countries except for 2. Walmart, and they've been criticized for their imports from China, employs over 2.7 million people, more than half the population of New Zealand. And the top 2,000 companies in the world generated more than half the world's GDP. Now, we may be small business, but we also may be customers or suppliers of larger business. And these are critical issues. Second, it's really the incredible value of stakeholders. And this, I think, has to be really brought out and brought to home. Because customers, you really don't own your customers, but sustainable growth of your business will not come unless you nurture and grow your customer base. And that's critically important. And
build loyalty, essentially build loyalty. Yeah.
And loyalty, exactly right. You'll never grow your business if you don't maintain that reputational value. The second is a skilled workforce. Turnover, loss of institutional knowledge are value destroyers. And it's so critical, especially in small to medium-sized business where you see larger and larger turnover. It's absolutely critical to maintain customer loyalty and employee loyalty. And we also discussed, of course, supply chain management. But here are a couple more items to think about. And that's really the community that you live in provides health, education, welfare, and safety, as well as infrastructure. That's what they give you. And the question then is, how do you give back to your community to increase that reputational capital? So basically, my perspective is sustainable value requires an understanding and evolution from this, what we used to call the shareholder-centric world to the stakeholder-centric world of all your customers.
And in a smaller business, you could change that sort of terminology and basically say the owner primacy to the stakeholder balance, stakeholder primacy. Is that
Right.
fair? Yeah.
Absolutely. Or your partner or your key employees. Absolutely.
Excellent, excellent. Okay, next slide, please. So,
So Steve, let me ask you some questions now. Okay. In the context of these trends, how would you define sustainability and ESG, and how do they apply in business?
yeah, it's interesting. There's so much discussion around these two terms, and they're being used, everywhere in every particular manner. And there's still some confusion as to really how they're defined and how they're positioned in the marketplace. So if we go to the next slide, we'll look at some of the examples of how these terms are used. Now, just to go a little bit just slightly back into history, until the 1980s, sustainability really was back to what Rick was talking about, which was sustain the business through profits. So the definition of success for a business was really a profit-oriented success measure and performance measure. In 1987, the United Nations began to unpack this concept of sustainability and broaden its definition. And so this is some time ago, 1987, but here was their definition of sustainability at that time: meeting the needs of the present without compromising the ability of future generations to meet their own needs. So meeting the needs of the present, okay, so doing what we need to do today without compromising, I'll just add my own sort of interpretation, without doing damage, for the ability of the future generations to continue to be successful and to continue to meet their own needs. So what the UN was beginning to do in this sort of simple and brief sentence was begin to put forward this idea of a broader responsibility for business and a broader responsibility for nations, for societies, for individuals. And if you look over on the left, on the graphic on the left, people, planet, and profits, people, planet, and profits, it's a term that was introduced in the mid-90s. And it was, again, pivoting off of the 1987 UN definition. This was this purpose that Rick was talking about earlier, which is this broader purpose and responsibility. People, social responsibility, planet, environmental stewardship, and profit, success and sustainability of a business. In the mid-90s, Ben and Jerry's ice cream also were pioneers in this sustainability movement that we're seeing today. If you look at, this is a graphic over on the right where it says our product mission, our economic mission, our social mission. This was one of their original mission graphics. And again, this is 1995. This is quite some time ago. It's nothing was happening in sustainability as it is today. But they were visionaries. They were basically saying, look, we have a mission oriented towards our product. I mean, make fantastic ice cream. It's a simple mission, but it's a profound mission. They had an economic mission. They wanted to have a successful company that not only had current short-term profits, but was successful in the future. And what you don't see on this graphic is they wanted the company to be successful, not just for the owners, but for the employees, for their suppliers, for the communities that their stores operated in, etc. And then finally, they had a social mission, which is the people part of people, planet, and profits, which is find innovative ways to serve the community. And again, back in 1995, Rick, I think you would agree. This was a vision for Ben and Jerry's, wasn't it?
It's pretty revolutionary, Steve, if you think about it.
Absolutely. So if you go to the next slide, pivoting off of this people, planet, profit, what we see today is this term being used quite extensively, and it's being used quite extensively for a few reasons. ESG, so E is the environment, S is social, and G is governance. The environmental category, the E, obviously deals with things around the planet, climate change, greenhouse gas emissions, resource depletion, etc. The S, as you might expect, deals with diversity, equity, and inclusion. Rick mentioned earlier, employee working conditions, health and safety. And then the governance issue are the traditional issues that countries, communities, businesses deal with in terms of ethics and diversity and fair pay, etc. So this combination of E, S, and G is particularly relevant today because these are actually measurable impacts and outcomes, either of a country, either of a community, or a business, large or small. We're seeing more and more measurement around a company's impact on the environment, positive or negative, a company's impact on society, positive or negative, and a company's impact on institutional governance, positive or negative. So we're seeing that the ESG term is, of all the terms being used in the sustainability space, the term that's being positioned as the most measurable way to measure the performance, the sustainable performance of a company. And you'll see in different companies, even companies of smaller sizes, they're beginning to measure tangible and intangible impacts on the environment in terms of the types of how they source their materials, as an example, their impact on society in terms of fair pay and working conditions, as an example, and impact on governance in terms of their ethical standing and their position on fair pay and working conditions. The next slide, please. So what we see on the right here is an example of a company that I wanted to share with you. It started out as a startup, like most companies do, like some of your companies perhaps in the audience. And what's uniquely fascinating to me about this company, and the company's name is Bombus, B-O-M-B-A-S. Some of you may be aware of it. They sell socks. And just like a Gen Z or a millennial company founding, they have figured out how to manufacture socks better than anybody has in the history of creating socks. So I buy Bombus socks. They're absolutely terrific. They figured out all the things that annoy you about socks and sorted that out. But you know, what's important about Bombus in terms of our discussion today is at startup, during the startup phase, they made a decision that they were going to be a sustainability-based purpose and mission organization before even sort of doing anything to develop the company. What they did was they did research, and they discovered in their research on the social responsibility sort of lens that homeless shelters, the #1 item that was most requested in homeless shelters around the world was socks. And so they said, this is perfect. We will build in a socially responsible business model that says for every pair of socks that we sell, for every individual pair of socks we sell, we will donate a pair of socks to a homeless shelter. And they started doing that. They sell a pair of socks, they donate a pair of socks. They began doing that from the first day they started business. And if you fast forward a few years now, they are a multi-million-dollar organization. So they have hit the exact sort of theory that Rick was talking about earlier about having this integrated purpose of people, planet, profits. They have basically hit that nail directly on the head. They are the success measure, one of the success measures of doing that. And you know, tens of millions of pairs of socks have been donated since Bombus opened their doors. Next slide, please. This is another fantastic example, and this is a local New York-based small business example. This is Graystone Bakery. In the sustainability world, they are rock stars, Graystone, and I'll describe why they're so popular and they're so revered in the sustainability world as a business. So Graystone is located in Yonkers, and since their opening in 1982, they again decided to open with a sustainability, purpose-driven mission. And so since their opening in 1982, they created this concept called open hiring. They even trademarked the term open hiring practices. And their open hiring business model is they will give anyone the opportunity to work at Graystone, regardless of their backgrounds, regardless of their history, regardless of their education. Their mission is to provide opportunities to people in the community to work at Graystone. And it's been just a remarkable success. And so if you can see in the second bullet on the right, when you buy brownies, you join millions of others in contributing to this mission. So now they've not only provided the opportunities for workers, but they've brought the community in to say, look, if you buy our products, you're actually not just buying products, but you're contributing to this broader mission. Similarly to what Bombus is doing in their mission statement. If you buy our socks, we're not only gonna use your money for our profits, but we're gonna use some of your money in buying socks to make a donation to homeless shelters. And you can see at the bottom, at the second part of the slide, it says a shared purpose. So Graystone has a shared purpose of people, planet, profits. Contributes to a brighter future for Graystone's bakers and a more equitable, inclusive world for all. And Graystone is also a certified B Corporation. We'll talk about that a little bit more later on. But the certified B Corporation is an organization that provides assistance to companies of all sizes, including startups and small businesses, to help them sort through how best to integrate sustainability into their business models. Next slide, please. So we gave you a little bit about why sustainability is a mandate, how this sort of ecosystem of business has changed, a little bit on the terminology and the applicability of sustainability for two examples of small businesses. And now I'm going to go back to Rick, a question about so look, I'm a small business, right? I'd like to do this. I have limited resources. What are the cost benefits of me even thinking about doing this?
So I would argue that there are many rewards to integrating sustainability into your small business. Again, we could look at sustainability as long-term value creation. And first, we know that sustainable businesses are more profitable than businesses that are not. But it's also sustainability over time it's also a mindset. It's good for business. It's good for your customers. There's a competitive advantage. And today, especially, it satisfies the need to the customers, the demands of the customers. And that's absolutely so critical. And you know that, and as I mentioned before, supermarkets that are selling, these new brands, actually, customers are paying a 20% premium over, the traditional brands to buy these because they believe in sustainable products. And then a recent study of young professionals showed that over 70% of new entrants into the workforce want to make the world a better place. And these customers are customers of your products and services. They're going to add to your reputation and customer base and clearly become more and more loyal to your service or brand, which actually is more profitable.
And Rick, the term cost always intrigues me. As a CPA, I have, there's a certain sort of very tangible definition of cost. But in the sustainability space, Rick, there is a cost of not acting in this, in integrating, at least taking some baby steps into integrating a sustainable purpose. And the costs are stakeholders sort of reacting negatively to your business model. Is that fair, Rick?
Absolutely. In fact, there's some online distributors that the next generation will just not do business with because of their reputational destruction by not paying attention to some of the issues of ESG.
And through social media, they can be very vocal and get to a lot of people in a very short period of time with their criticism. So,
Yeah.
so,
What did
so
more?
I think costs need to be looked at beyond sort of bottom line cost and more back to the reputational cost that you discussed earlier.
Warren Buffett had one of those long, great quotes. He said, it could take years to build reputation, and all you need is one bad actor to destroy it.
Absolutely. Next slide, please. So, Rick, would you like to summarize here on the cost benefit?
Yeah, I think you have to ride the wave, because over time you're going to be more profitable, or your longevity of your business is going to be better and stronger. And frankly, if you're looking to be acquired by a larger business, a sustainable business that creates long-term value is much more attractive today to investors and mutual funds and pension fiduciaries.
And Rick, even lines of credit, simple banking relationships are increasingly integrating terms that are related to social and environmental impacts and outcomes. Even the rates of interest charge are being influenced by whether or not the institution, the lender, the financer, if you will, is going to see metrics that are associated with environmental and social responsibility.
Steve, I think you had talked a little about this, and it's fascinating that some of the largest banks are actually lending at a lower interest rate if they see that this is a sustainable business that's capable of long-term value growth.
No question about it. Next slide, please. Okay, so Rick and I are both going to, we're coming to the sort of the conclusion of our prepared discussion, and then we'll open it up to Q&A. But we wanted to touch a little bit on what a small business can do if they're beginning to think about integrating ESG, if they just started integrating ESG, or perhaps they're uncertain on whether or not to integrate ESG. So the next slide, we have a few suggestions.
Yeah, and Steve, can I comment on that as well? Because I was thinking, as we speak and as this evolves, it seems to me any business, like a small business, can create a balanced scorecard of its tangibles and intangibles. Basically, it could identify its mission and purpose. It could also take an inventory, and you could actually ask yourself, how do you grade yourself? A to F on your relationship with your customers. A to F, your relationship with your employees. A to F, your relationship with your vendors and suppliers. And how about your supply chain? It's like a balanced scorecard that anybody can do, and you can actually rate yourself. And that's a great first start, it seems to me.
Absolutely. In fact, one of the advantages that smaller businesses have is, generally speaking, they tend to be more in touch with those stakeholders and more accessible to those stakeholders. And in fact, that self-assessment can actually become a conversation with your customers, with your community members, with your vendors, with your bank, your financing relationships, and basically saying, hey, what do you think? What more can we do? What are your expectations? And those are terrific conversations. Yeah. And they feel like they have a voice in your business model and a voice in your products and services. And again, it comes back to this sort of transparency, this collaboration, and then this building loyalty to not just customers, but to employees, to suppliers, and to the financing community as well. Next slide, please. So we listed just 5 very basic steps. Rick began to discuss these, but these 5 steps, this is generally a good order of these steps. So if you do something like what Rick described as either self-assessment or do a sort of a socializing with your different stakeholders, your employees, your customers, and ask them what their views are about your business, about your products and services. Then what we believe is the first thing that you come back to that would make this whole thing much easier there's some companies that are checking the box here, honestly, with the sustainability movement, Rick. And so some companies are just trying to say the right thing. They're trying to, put the right terms on their website, in their marketing brochures, and their advertising, but not really a lot of passion around what they're talking about, and not really a lot of substance around what they're talking about. So we list as number one as passion. We gave the example of Bombus. You could do so many things in the environment. You could do so many things in society. They were very narrow, but very deep. They said, look, we can't be everything to everyone. We can't do everything. In fact, we're really going to focus on the S in ESG more than the E. And in the S, we're going to be very narrow and focus on homeless and the homeless shelters. And that's their passion. And when you look at Graystone, the Graystone example, their passion is more deeply rooted in the community, into inclusive hiring, and to making a difference in people's lives who may not have opportunities to work in other organizations because of traditional, old school perspectives. So number one, we look at passion. If you can find, or you probably already have a passion in your business about something, and if you could link it to the S or the E, that goes a very long way, Rick.
And from a media perspective, there's nothing more positive than having that passion, and the media gets wind of it, and suddenly your customers and future customers get wind of it too. And I mean, Steve, you mentioned Bombus, and what an incredible PR. I mean, it's working, but it's also profitable.
And it's also real. They also really believe in it, and you can't fake that. You could fake. Businesses can fake some things, but you can't fake true passion, because their employees feel this, their customers feel it, their vendors feel it. It's contagious. It's a bad term during the pandemic, but it is. So once this passion is sorted out, and you probably already have this, it's not like you need to go look for it. Just need to sort of begin to link it to the purpose, which is step number two. And Rick talked quite a bit about purpose, but this is really the integrated purpose of people, planet, profit / success and sustainability of a company. And let me just add one thing on the profits piece. Some people get a little bit sort of uncomfortable when you say, we exist for profits, but I do not get uncomfortable personally. And if a company is not profitable, they're not going to survive. And if a company doesn't survive, they're not going to be any good to their vendors. They're not going to be any good to their customers. They're not going to do any good to their community. So the profit piece and the long-term success and survival of a company is crucial, just as the social responsibility and environmental stewardship aspect is crucial. So once we have the passion that's integrated and aligned with the purpose, then you begin to do what Rick mentioned earlier, is sort of this inventory of what is my passion purpose impact on the E, the environment, on the S, society, and on the G, my company's governance. Rick, any other thoughts on this as we proceed?
No, and I think it's easily possible to do that balanced scorecard and actually rate yourself, and then look at yourself over time, because the higher your scorecard totals go, the better chance you have long-term value creation of your enterprise.
And Rick, balanced scorecard sounds like a Fortune 500 company sort of tactic, but tell me how that would work in a small bit. Like, what is a balanced scorecard?
I think you could look at all of the items that we discussed, your customers, what is your retention rate of your customers? In magazines, what is my subscriber first year renewal rates, my subsequent renewal rates? Do they like me or do they hate me? Are they going to go to a competitor? That's your customers, but your employees.
And if I have a cafe, what types of complaints am I getting on a monthly basis?
Exactly. And am I responding to that? As far as employees, a stable workforce. In Europe, the FTSE 500 companies now require you to talk about your turnover, your compensation to the senior executive, levels in management of male and female minorities and so forth. They're very interested in that, and the public is interested in that. So you can measure that. These are all measurable. So yeah, we use balanced scorecard in the Fortune 100 or the Fortune 500, but we can do that in the smallest business if we look at what we're measuring. So we have all the stakeholders. That's right. Supply chain. Do we pay attention to where the sourcing of these materials come from, and who's working, and under what conditions are they working? There's an example.
Right.
Yeah, Steve. There was
Yeah.
a couple of years ago that one of the #1 fashion industry firms practically went out of business because of a factory fire in India that made fashion clothing. They did not pay it, and they didn't own the factory, but they didn't pay attention to these workers who were supplying fabric to them.
Absolutely. So step 4, we talked about quite a bit, which is identifying your key stakeholders, and I think we sort of hit that pretty substantially. But finally, number 5, at some point, we call this reporting. You could call this communication. You could call this branding. You could call this advertising. At some point, large, medium, small companies need to begin to communicate what their passion and purpose is and what impact they're having on environmental stewardship and social responsibility in terms of what they've decided to focus on. So the final step is to sort out how best to communicate. Is it a formal report? Is it something on the website? Is it blogging? But at some point, the expectation for all sizes of companies now is there will be transparency and there will be frequent communication on environmental stewardship and social responsibility issues. By the way, positive and negative. And so stakeholders are savvy enough to know when they're given sort of an exaggerated positive perspective on some of these things, right? So next slide, please. For those of you keeping the slides, we have some links in the event you want to dive deeper into some of our sources. And now we will turn it back over to our hosts to open it up for some Q&A, if any.
Steve and Rick, thanks so much. That was terrific.
Thank you.
Renee, if I could just jump in, I have a couple just quick takeaways and hopefully some tie-ins to future services for those of you who are with us. I mean, the things that really jumped out at me, were this is really, it's a bottom line issue. There are financial reasons for you to incorporate this into your business model. Steve and Rick had talked about, customers who are able and willing to kind of spend more based on sustainable business models. A lot of customers are really looking for that. So I think that you're identifying prospective new sales opportunities. And from the marketing perspective, I think being able to build this into kind of who you are, the messaging you're trying to get out there to prospective customers, I think is crucial. And I guess the third sort of takeaway, there are many, but 3 that jump out, I guess, is the importance of supply chain. I think, your references are so, insightful, I think, in terms of making sure that, who you're getting it from has the capacity to deliver and don't, impose any prospective reputational risk for you because you want it to be, positive impacts in terms of customers' perspectives of who you are and what you're doing. So, a couple of quick thoughts, but anyway, thank you so much. It was terrific.
Okay, thank you for hosting us. We appreciate the opportunity.
Absolutely. We had a request to put up the last 2 slides, so I'm going to jump back to the references here. Folks can screenshot it if they want.
And also, if there are follow-up questions, totally happy to entertain them.
Very cool. Is the best way for them to email the SPDC@PACE email address to get that contact information, Andrew? Okay, perfect. All right, we have some really good questions. I think you're going to be excited. This one's from Michael. Any suggestions or case study lessons for those of us with the ambition of forming multiple sustainable companies that form synergies? I'm thinking of a non-sustainable, clear example of this. It's Disney, where their movies, toys, adventure parks, hotels each attract the customer to partake in the other arms of their business. Any sustainable ones with great success?
I'll give that one to you, Rick.
Well, I could tell you that, I've worked in corporate most of my life, and I was head of product development, and these are called literally product extensions in new markets. So if you come up with a concept, you say, well, how can this concept be applied in other markets? It could be food, could be clothing, could it be toys? For example, Stanford University makes more profits from their sales of T-shirts and flags and some of their sports memorabilia that they actually do from tuition. So these are product extensions, and good at product development. You brainstorm around around a table and say, where else can these products fit?
I at the risk of overstating Bombus, and I don't own, I don't have any influence on Bombus. I get no benefit from this. They're now extending their product line to T-shirts and things of that nature, but they're going to follow the same sort of passion and mission where they're going to be donating for every T-shirt they sell. They're going to be donating a T-shirt to a homeless shelter. So I think it's the product extension and then the passion purpose extension that dovetails with it. Right.
Right. The one caveat I will say is if you don't know the business, find a partner that does, because
Yeah.
that could be just deadly.
Absolutely. Thank you. If you are a brand new business, should you prioritize ESG, which will have a direct effect on cost and possibly be a deterrent, or should you wait until your company has a secure customer base first?
I'll start with that one, Rick. I think that's first of all, that's a fantastic and a very fair question, and as a CPA, and that can be very focused on tangible bottom line. That's a very real issue. But having said that, I think there are ways to begin to build ESG in immediately without sort of ratcheting up costs associated with it. And I think it comes back to it's really, particularly for a small business, but really for any business, it's very fair. And your stakeholders will embrace the idea that, hey, look, I can't focus on many things. I'm going to focus on one thing very, very, very deeply because we feel passionate about it. And we're just getting started. So we have plans on what we're going to do with this. As we grow, we will continue to invest in this passion and in this social responsibility passion, as it were. But let me just tell you that this is the direction we're going in. We want to build a business from the first day on that's not just linked to traditional success measures, but it's linked to success measures that extend to the environment and to society. But stay tuned. We as soon as we sort of build more momentum and build more resources, we're going to continue to build on these. Frank, if you have any thoughts on that.
Yeah, and I would say that when you first begin, the question you have to ask is, might you have a competitive advantage, even if the cost is higher, that you could price higher if you integrate some level of a sustainable product in your portfolio? And also, Steve talked about, your profits with purpose and your future mission. Well, you could start small and say, here's where we are, as you say, Steve, but a year from now, here's where we want to be. 2 years from now, here's where we want to be. 3 years. But I would say if you don't think about sustainable value in creating your initial product and have a differentiator that has a competitive advantage in the marketplace, I think it's going to be more difficult. I think your cost of entry and the barriers to entry will be greater.
Particularly if you need angel investing or some type of funding from someone other than your owners or your core team, they are, regardless of the size of the business, they're going to be considering those issues, right?
Steve, I think you're right. I think the chance of them getting funding is actually greater if they mention that, let's say, in their prospectus or something like that.
Exactly. In my MBA classes where we do strategic planning and we give case studies on new product development or new business formation, this ESG is a requirement of the case study. Is just to build in an ESG, sort of integrate an ESG part of the business plan.
What are each of your thoughts on how B Corp compares to other sustainability impact-driven certifications for small to medium businesses? Would be helpful to hear about certifying bodies other than B Lab that might complement, supplement, or as holistic, if not more, in their structure.
So for those of you that may not be familiar, so So B Lab is a non-for-profit organization that was founded with the mission of assisting organizations in not just helping them to integrate ESG into their business models, but then to give them a methodology and a process whereby they can do a self-assessment on their social responsibilities, a self-assessment on their environmental stewardship, a self-assessment on governance. And they scale that self-assessment based on the industry and the size of the company. And then that self-assessment is submitted to B Corp or to B Lab, I should say. And then the B Lab assessors work with the company to sort of evaluate the self-assessment. And then, as Renee mentioned, the B Corp would ultimately provide a certification, a B Corp certification to the company that then after periods of time needs to be refreshed and renewed, et cetera. So it's wonderful. The B Lab and B Corp model is wonderful because it not only provides a somewhat independent sort of assessment that you can sort of brand to the marketplace. If you notice Graystone example in the slide, and if you get the slides, you'll go back and see that they have the B Lab and the B Corp certification prominently displayed on their website. But this question is such an important question, and it's in such a nascent stage right now. That question, it's really evolving rapidly. Is this idea of third-party credibility, and so we sort of touched on this earlier. But big, large, and small companies, some of them are, let's just say, maybe exaggerating on the positive impacts they're having, and maybe understating the negative impacts they're having. And so what's happening now is there's a movement of third-party, what we call third-party assurance or third-party attestation or third-party sort of credentializing of companies. So if a company, let's pick a large company, Pepsi issues a sustainability report, they will hire a firm to come in and look at the metrics, the performance metrics, look at the assertions that they're making about their environmental and social impact, and look at evidence that those assertions are reasonable, and then provide a report that says we looked at these sustainability measures that are being reported and we believe that they're fairly stated. This is beginning. This is only at the beginning stages to happen. So CPA firms are providing attestation. B Lab is providing attestation. There is a range of small vendors that are now in the business of providing third-party attestation. I just caution everyone that it's very early stages, that the level of attestation, which means how much they look at and how much they charge and how long it takes, varies substantially. What I can say with certainty, and then I'll turn it over to Rick for some comments, is that assurance is the next big wave that increasingly we're seeing in Europe, we're seeing in South Africa, that now there are regulations being passed that actually require larger companies, mind you, to have third parties come in and provide some level of assurance over what's being reported on certain sustainability reports and measures. For smaller companies, something like B Lab is an affordable option, or some of the smaller vendors are affordable options, and you can scale the level of assurance to having some very basic assurance to very more narrow detailed assurance. Rick, I'll turn it over to you.
Yeah, I think really it's in its early stages, but I think the real question, and I think it's dealing with your own honesty, what is critically important that is going to create the value for the future growth of your business. For example, you could say, oh, our office is carbon neutral, but at the same time, you could be sourcing, say, sheep from, a third world country, where, the waste is so great that it's destroying neighborhoods in the water. So you really have to have some honesty to what it is you're measuring. There's a statement they always say that what is measured often does not count, and what counts often is not measured. So I think you really have to have some intellectual honesty about your business and say, this is really important. It's important to me, it's important to our customer.
And by the way, what Rick is talking about is part of the G in ESG. That's part of the institutional governance part of ESG. Okay, Renee?
Do you believe that if we continue to integrate sustainability into our everyday lives, that the cost of sustainability will decrease and it'll become the norm? Also, is there anything that we can do to combat greenwashing of brands and companies?
Rick, I'll let you start this time.
So, there are companies, I've attended a lot of conferences where the consulting firms are basically in the business of greenwashing. So, they will, again, they're counting things that are unimportant, but it looks good. So the question is, does sustainability cost more or does it generate more revenue for you? I think you really have
long-term value, really.
Yeah, long-term value creation. Short-termism. A lot of the companies, the corporate graveyard is littered with large corporations that were on short-term profit growth, and I can think of Kodak and some of these other companies that really never evolved and look towards 3-year, 5-year plans. In Japan, they have 25 and 50-year plans in their corporations, as an example. So so I don't know if it's going to cost more. That's really the question. Or in the long run, will it generate more? So I mean, that's really the question that I think you need to answer.
Yeah, I'm just going to add a story. So we talked about B Corp earlier. I'm working with the head of B Lab in Ecuador. They had a sustainability conference, and I was the keynote speaker for their conference in Ecuador. And one of the stories that was shared at the conference was during COVID. If you think of Ecuador, just like a Latin American country, even if it's a small company will have many smaller their supply chain consists of many small vendors, family businesses, etc. So a mid-sized dairy farm in Ecuador during the pandemic, just like many businesses around the world during the pandemic, saw their business literally shut down, sort of sales basically almost shut down to nothing. And fortunately for this dairy farm and for the CEO and the leadership team, they had a bit of a piggy bank. They had some resources that were going to sort of get them through this dark period of no sales or limited sales. And of course, when they looked at their financial position, you look at, well, how can we cut costs? And so of course the suggestions came up to the team that basically said, look, we could cut some of these suppliers and the payments and as the CEO tells the story, and this is a wonderful story in my view, he says they sat back and they said, look, these suppliers depend on us for their survival. These are small family-run businesses, and they've been loyal to us when we started out, when we weren't that successful. They made accommodations for us all through these decades, and they made a decision that basically said this is going to cost us a little bit more money going forward. We're not going to be able to pay them fully to what they were getting on a monthly basis when business was normal, but we're going to keep them all as employed as we can through, and they did that. And so it somewhat relates a little bit to this idea of cost. And so what, of course, they're going to be loyal to this dairy farm for the rest of their days after this. And so it goes back to what Rick said about creating long-term value. There might be some short-term expense, and of course, you don't want the expenses to rise to the point where where you're threatening the business. But if it's strategic and it's oriented towards this idea of an integrated purpose that is going to resonate with your stakeholders, your financiers, your banks, your community, your employees, your vendors. The statistics are already out there. Inevitably, this will create a long-term value.
Thank you. I saved a long one for last, and I'm also going to send it to you in the chat just in case you want to reference it, but I'll go ahead and read it as well. It's a question on sustainable supply chains in relation to manufacturing during times of normalcy and times like now. Given there are way fewer factories that produce sustainably along with higher ethics standards and the general risk of factories halting production for any reason, if not at will, how can we go about approaching other factories to have backup supply chains like the Puerto Rico example you gave? The difficulty I'm foreseeing is that the backup factory or factories would force really undesirable terms and considerably higher production costs on a brand when they realize they need them to produce in order for you to live as a brand and satisfy customers? Is it even industry standard to have those in the event of contracts and have backup manufacturers ready in case things go wrong with supply chain?
So I would look at this in a slightly different way. Over the last 40 years, manufacturing has become more efficient because of the focus on just-in-time inventory. Basically, maintaining the least amount of inventory, the least amount of goods in your factories or in your warehouses, because you're more efficient and because there's a cost to maintaining it. One of the things I found from my course, my students in risk management, and these are Fortune 100 executives who took this, is that this attention to just-in-time inventory has an incredible risk to it if you have absolutely no backup or any storage facilities or any warehousing capabilities. So I would say if you have actually critical parts, like, for example, microchips or something that absolutely are needed, throw away just-in-time inventory and put into place what risk mitigation you need within your manufacturing enterprise. That way you won't be gouged by third-party suppliers.
Perfect. We have so many thank yous rolling in. Michael said this is a rare to come by and so incredibly important topic as we create the future together. Thank you, Michael, for that
Thank you,
comment.
Michael.
Again, Steve and Rick, thank you so much. Always really insightful and a lot of very solid takeaways for both myself as well as for the attendees. So really appreciate it.
Thank you. Renee, thank you for
Thank you, Renee.
hosting us.
Thank you.
Thank you, Renee.
No problem. And you know I'm a Bombus fan.
Exactly.
Happy to host us anytime.
Apparently your dog is as well.
Oh yeah. Oh yeah. Few pairs down. All good. I hope everyone has a great week. Thank you so much for attending and bye.
Thanks.
Everyone.